How is it going, family? Welcome back to the channel. I know it's been a while since I uploaded here. I've been working on improving my quality and making better videos like this for you. So if this is your first time coming across this channel, please don't hesitate to like and subscribe, as it really motivates me to keep creating free educational content like this. Thanks. So in today's video, we'll be discussing the relationship between external and internal range liquidity, how I use them in my day-to-day trading, and I will also walk you through some trade examples I took using this model. So let's get into it. So the market only does two things. It's either refilling an imbalance or seeking liquidity. Internal range liquidity is basically an area of imbalance in price where the market needs to rebalance and pick up orders. This is what we usually refer to as a fair value gap, order block, or an internal hold levels. On the other hand, external range liquidity refers to the hold highs or lows where the market looks to offload those orders. So after the market picks up orders from a fair value gap or an order block, which represents the internal range liquidity, it will then go on to seek external range liquidity at those hold highs or lows. And honestly, that's literally what the market does over and over again. Now, let's jump into some real trade examples I took using this model so you can understand it better. Here we are on our first example with gold's daily chart. I normally start my analysis from the daily time frame as a day trader, then scale my way down to the lower time frames to look for that daily expansion opportunity. The daily time frame is what I use to build my daily framework. It helps me understand which liquidity the market wants to seek next, whether internal or external. In this example, we can see an uptrend structure where price is moving towards external range liquidity after previously picking up orders from internal range liquidity, which in this case came from a fair value gap. We then have a strong bullish close with the previous day candle. This is a clue that the market was likely to trade higher on the next daily candle. Now, in order to be part of that move, I marked out the equilibrium of previous day's candle. From there, I look for internal range liquidity inside that previous day's range, preferably at or above the equilibrium level, to trade away from to the direction of the higher time frame trend. Dropping down to the 4-hour chart, just above that equilibrium level, we can see a 4-hour fair value gap that we can trade away from. So I'm expecting the wick of today's daily candle to form inside that level. That will then create a move from IRL to this 4-hour equal high defined as ERL. As soon as price retraced back into this 4-hour FVG, I then dropped to the 15-minute chart to look for entry. And for my entry, I look for a liquidity sweep plus a change in state of delivery in the anticipated direction. And in case you don't know, a bullish CSD is simply a candle closure above the candles or series of candles that swept liquidity within a higher time frame key level. So during the London session, we got a 15-minute CSD. This signified a potential reversal, showing that the market was now ready to seek external range liquidity. I didn't enter there though. I waited for New York session, and right at the open, price retraced back into the 15-minute fair value gap and we got another CSD. That's where I entered the trade. I placed my stop loss below the CSD low and my target was the 4-hour external liquidity. So essentially, we had a complete move from IRL to ERL, perfectly following the model. For our second example, we are looking at GBPJPY. Starting again on the daily chart, we can see that price has just taken out an external range liquidity resting at an old low and immediately gave a sharp reversal. Above price, we also have an old internal high, which now stands as internal range liquidity the market would likely want to revisit. Looking at the previous day's candle, it closed as bullish, and that gives us a clear clue to expect bullish continuation on the next daily candle. As always, I marked out the equilibrium of the previous day's candle, expecting that level to hold as support for price to continue higher. From there, we dropped down to the 1-hour chart to look for a trade opportunities that align with this higher time frame idea. On the hourly chart, During London session, price took out an internal old low and then gave a reversal. That reversal signifies that the low of the day has likely been set, meaning we can now start looking for continuation during the New York session. And right at the New York open, price retraced back into an hourly fair value gap. That's an area where we anticipate a move from IRL to ERL. So from there, I dropped down to the 5-minute chart to refine the entry. And on the 5 minutes, all I'm looking for is a liquidity sweep followed by a clean change in state of delivery around that key level. After the CSD formed, I placed a limit order at the retest of the down close candles, set my stop loss below the low and targeted the external liquidity above. Price tapped into the setup perfectly and delivered straight to our target, completing a clean 1-hour IRL to ERL move. Back to the gold daily chart, we can see the market is in a bullish condition and we just had a retracement back into an order block which stand as our internal range liquidity. And price is showing clear signs of respect around that level. From here, we can anticipate the market will seek external range liquidity at an old high. Again, we mark out the equilibrium of the previous day's candle and then drop to the intraday time frame to look for trade opportunities. On the 4-hour chart, we have a fair value gap just above the equilibrium. This is the zone we expect the wick of the current daily candle to form, meaning it's the level where price could retrace before expanding higher. From that 4-hour gap, we can then anticipate an IRL to ERL move. So then we drop down to the 30-minute chart for our entry. And as always, we look for a liquidity sweep followed by a change in state of delivery around that key level. Once the CSD is confirmed, we set a limit order at the opening of the CSD candle, place the stop loss below the low and target a 2-hour move in the direction of the external liquidity. As you see, price tapped in cleanly and quickly delivered straight to our profit target. And this is a complete move from daily to the 4-hour IRL, defined to a 30-minute entry and smooth delivery to the external range liquidity. This last example covers a GBPUSD trade, and starting as always from the daily chart, we can see the market is in a downtrend and the previous day closed as a strong bearish candle. That gave us a clear clue to anticipate continuation to the downside. The previous day's low stand as our external range liquidity. So we then mark out the equilibrium of the previous day's range to look for trade opportunities around that level. Now dropping to the hourly chart, we can see a fair value gap acting as an internal range liquidity right around the equilibrium. And just at the daily open, price trades back into that FEG. And during London session, we got a change in state of delivery to the downside. That is our first signal that the market is ready to seek the external range liquidity. And from there, I drop down to the lower time frame to refine my entry, aiming to ride the move from 1-hour IRL to ERL. On the 5-minute chart, we simply look for a liquidity sweep plus a CSD. In this case, we did not get a sweep, but we have SMT, meaning that the correlated pair, which is EU, swept the high, but GBPUSD did not reach that same level. Right after the CSD formed, I market executed my position, placed my stop loss just above the SMT candle's body, and aimed for the external range liquidity, which in this setup was the previous day's low. And price then dumped aggressively straight into the target. Clean move from 1-hour IRL to ERL, exactly as anticipated. Now you understand how I use the relationship between internal range liquidity and external range liquidity together with the previous day's range to look for trade opportunities in the market. You can backtest this, collect your own data, and start using it to your advantage. Always begin from the daily time frame and then work your way down. Look for a sweep plus CSD setup at or around those higher time frame key levels. And that's how you cut out all the unnecessary noise and stay focused. Take note on this and go study it out for yourself. So that will be all for this video. Don't forget to like, subscribe, and share with your fellow traders if you found value in this. And if you are looking for a reliable broker, I've dropped the link to the one I personally use down below. You can check it out. Peace.